Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Our topic for this lesson is multiple step income statement. At the end of this session, you should be able to prepare multiple step income statement from a list of balances. Now, let us talk about the multiple step income statement. This income statement is designed to provide classifications and subtotals to distinguish between the major operations of the entity and other activities. Its main purpose is to provide users of financial statements with relevant information pertaining to the profit or loss from the entity's primary operations, as distinct from profits or losses from secondary activities. What that is saying is that it separates the primary operations from the secondary operations. And we'll talk about preparing the multiple step income statement. You'll find that there are two sections. It allows for deeper analysis of margins and provide more accurate representations of cost of goods sold to the users, the stakeholders of the accounting information. Let us now get into the preparation of the multiple step income statement. As indicated earlier, there are two sections. The first section focuses on the operations, which includes expenses and revenues from the business's primary operations, while the second section focuses on providing information on the expenses incurred in generating the revenues. So we're now going to look at an actual preparation of the first part of the multiple step income statement, where we'll be generating the gross profit. The question that is used, read, the following activity will give you practice in calculating gross profit of a merchandising firm. The following information was extracted from the books of Vinci Enterprises on December 31st, 2010. Now I must point out to you that this question is taken from the Cape Accounting Unit 1 study guide. Now, the list of balances that you're seeing are typically the balances, the items that are used to generate the gross profit. So we're going to use these balances, people, to prepare that first part of the multiple step income statement. So the first thing that we're going to start with is sales, because remember, simply in calculating your gross profit, it is sales minus cost of goods sold. But within that preparation, that calculation, there are some items that you have to take into consideration. And please pay close attention to what is being done, because you'll find that it is different from what you're used to when you're doing even CSEC, that single step income statement. All right, so we pick up the sales, and from the question, our sales figure is $146,445. So we're going to enter that figure. Our next step, guys, is that you're going to look for your sales return. Yes, you're used to this. So we're going to less sales returns. And remember, sales returns is the same thing as the returns inwards, and that causes a reduction in sales. So hence we have to subtract that. Let's check in the question for the value for sales returns, and that is $2,640. We are going to record that. So remember, that is $2,640. And of course, you can put this in bracket to indicate that you are subtracting. Now, there is an item that you're going to find in this section that you don't normally use in this section, and that is sales discount. What is sales discount? Sales discount is a cash discount that the business allows to its customers so that they'll make prompt payment. It will encourage them to make prompt payments. That is the benefit given to the customers when they meet the particular term as it relates to the business. So if they say that if they pay within 10 days and that amount is cleared, they'll get 5% discount based on the terms of the business. So remember, in the multiple step, we subtract the sales discount. On a normal, what we'll do, we would have done with the sales discount, which is the discount allowed, is to list it among the expenses when we're preparing the profit and loss section of that income statement. So less sales discount. And the value for the sales discount is $1,805. Now we're going to do our calculation. And once that is done, the value that you have remaining is $142,000. This $142,000 give us our net sales because that figure is now adjusted. So remember, it is sales less the sales returns less sales discount. And that's how you got that net sales of $142,000. Bear in mind that not all questions will have sales returns and sales discount. You might just get one, or you may just not get any at all. Our next step, once we have our net sales, is the less cost of goods sold. So in this section now, people, we're now going to generate our cost of goods sold. And to calculate our cost of goods sold, the first thing that we need to look for is if there is any beginning inventory. And yes, we have beginning inventory of $8,245. So we're going to record that beginning inventory. And the value for the beginning inventory is $8,245. Your next step is to add purchases. And our purchases figure coming from the list of balances is $68,942. So that is 68942. What we're going to do next, people, is to look if there is any transportation in, and if there is any duty, or they may call it freight in, typically carriage inwards, any costs associated with getting the goods into the business. Yes, we have carriage inwards, that's the transportation in, and we do have duty on imported goods. Those figures, people, is going to cause an increase in your purchases, so therefore we are going to add them. So add transportation in, and the value for the transportation in is $4,044. And the other thing that increases the value of your purchases there is the duty on imported goods. And the value for that is $1,327. We're now going to find the total of these figures. And once you add those together, you get a total of $74,313. So remember, you add your transportation in, if there's any, and if there's any duty on imported goods, you're going to add that as well. Now, there are some items, there are two items that may affect the value of purchases, and that's going to decrease the value of purchases, and we now need to look for those items. If they're in the question, we need to subtract them. And these items are the purchases returns and the purchase discount. So we're now going to put in those two figures. So remember, we less purchases returns once it is in the question, and that is basically your returns outwards. And that value for the purchases returns is $1,890. And there is one more thing that we're going to subtract. Let's put this in brackets so that we can remember that we are subtracting that. The other thing that we are subtracting, once it is in the question, and we have it in this question, and that is the purchase discount. And the value for the purchase discount is $534. So remember, once you have purchases returns, that's going to decrease your purchases, so you must subtract that. If there is purchase discount, that also decreases your purchases, so you're going to subtract as well. The value that we have left after adjusting the purchases figure is $71,889. And guess what? This is our net purchases. This figure now is added to our opening stock, which is our beginning inventory. And that gave us a value of $80,134. Now, our next step is to check for ending inventory. So we are now looking for the closing inventory. And the ending inventory from the question is $7,614. So we're going to make a note of that, record that in our income statement. And remember, people, that you are to less ending inventory. Because after taking out your ending inventory, then you're able to ascertain your cost of goods sold. And our ending inventory value again is $7,614. And we are going to do our calculation now. So that is $80,134 minus $7,614. And that leaves us with a cost of goods sold of $72,520. Now, once you have that, now you're able to generate your gross profits. And remember, we are subtracting the cost of goods sold. So we're going to subtract this $72,520 from the net sales of $142,000. If there wasn't any sales returns, sales discount, then of course, the figure that you would have subtracted this $72,520 from would be the $146,445, which is our sales figure. So remember, because sales is adjusted, we're subtracting the cost of goods sold from the net sales to get gross profit. So that's our gross income. And the value for this is $69,480. And basically, people, that take us to the end of preparing the first section of the multiple step income statement, where our aim was to calculate the gross profit. In our next session, we will be looking at section 2 of the multiple step income statement.
Like, share, and don't forget to subscribe.